All right, let's break down Papua New Guinea's 2024 salary and wages tax. If you've ever looked at your payslip and just wondered how all those numbers add up, you're in the right place. We're going to walk through exactly what these new rules mean for your take-home pay. So, when you think about these new tax rules, what's the one number you absolutely have to know? Well, it all starts with the single biggest change, the one that affects pretty much every single employee in PNG. And there it is, K20,000. That's your new tax-free threshold. It means if you're a resident, the first K20,000 you earn in a year is all yours, completely tax-free. You can think of it as the starting line for all the tax calculations that follow. Okay, so what happens when you start earning more than that K20,000? Well, this is where it gets really interesting because the rate you pay completely depends on your residency status. And trust me, it makes a huge difference. And wow, just look at the difference here. For residents, that initial K20,000 is totally tax-free, which is a massive benefit. But for non-residents, and just so you know, that's anyone in PNG for less than 183 days a year, it is a whole different story. Tax gets charged from the very first kina they earn. There's no tax-free buffer at all. So let's look at the official table for residents. You'll see the tax is what they call progressive. After you pass that tax-free K20,000 mark, different chunks of your income get taxed at different rates. For example, any money you earn between K20,000 and K33,000 gets taxed at 30%. Now, let's flip over to the non-resident table. The big flashing sign here is right at the top, that tax-free threshold, it's gone. The rates kick in at 22% for every single kina up to $20,000, and then they start to climb from there, just like the resident rates. Now that we've seen the rates, the next logical question is, what exactly are they taxing? And this is super important to remember. Your tax isn't just based on your base salary. Not at all. The IRC looks at your entire compensation package to figure out what you owe. Yeah, the IRC's definition of salary or wages income is, well, it's pretty broad. Basically, if you get paid for your job, whether it's a commission, a bonus, or some kind of allowance, it pretty much all goes into the pot to be assessed for tax. So this brings us to one of the most common benefits that a lot of people get, accommodation that's provided by an employer. So the big question is, does the IRC consider your house part of your income? And the answer is a big, definite yes. But here's the catch. They don't tax you on what the actual rent would be. Instead, the IRC adds a fixed value to your income, and that amount depends on whether the housing is considered high cost or low cost, and where it's located in PNG. Okay, so this brings us to a key term you're going to want to know, assessable benefit. Really, it's just a fancy way of saying that these non-cash perks, like a car or housing, are given a cash value for tax purposes. That value gets added to your income, which means, yep, you pay tax on it. And besides housing, another really common assessable benefit is a company car. If your job gives you a car that you can use for personal trips, the IRS says, hey, that's a benefit, and puts a price tag on it. So how exactly does that work? You know, this part is actually pretty simple. If you get a company car to use whenever you want, a set amount gets tacked onto your taxable income every single fortnight. It's K125 if your employer also pays for the fuel, or a little less, K95, if you're footing the fuel bill yourself. Okay, so let's actually put all these pieces together. We're going to walk through a real-world example, step by step, to see how your salary, your overtime, and all those benefits combine to determine your final fortnightly tax. All right, step one, we have got to figure out your total taxable income. And to do that, you just add everything up, your gross pay for the fortnight, plus the set value for any of those assessable benefits you got. So let's take a look at an official example from the IRC. You start with your base salary, say K1,500, then add in some overtime and a bit of commission. Then come the benefits. You tack on K125 for the company car with fuel and another K160 for low-cost housing. Add all that up, and boom, your total taxable income for that fortnight is K1,896. Okay, so we have our magic number, K1,896. Now for step two, we plug this into the official IRC tax formula to see exactly how much tax should be coming out of your pay. Now, you might think they just take a flat percentage of that, but it's a bit smarter than that. To make sure it's fair, the formula actually takes your fortnightly pay and projects it out to see what you'd make in a whole year. Then it applies those annual tax brackets we saw earlier, calculates the yearly tax, and then divides that all the way back down to get your deduction for just that fortnight. It sounds a little complicated, but it just ensures you're paying the right rate for your overall income level. So, we have covered a lot of ground here. Let's boil it all down to the key things that you really truly need to remember. All right, here are the four big takeaways. First, and this is the big one, that first K20,000 you earn is tax-free, but only if you're a resident. Second, your residency status completely changes the game. Third, remember those non-cash benefits? Your housing, your car, they absolutely count as taxable income. And finally, the bottom line is this. Your tax is based on your total earnings, not just the number in your contract. So, now you know the rules. What does all this mean? Well, really, it's about empowerment. It means you can look at your own payslip, understand the numbers, ask the right questions, and just feel confident that your tax is being calculated correctly under the 2024 regulations. So, are you ready to check your next payslip?